Good morning, everybody. Welcome back to the Schwab YouTube coaching channel we call Trader Talks. It is Trader Talk in today's market on a Thursday morning. I'm your host, Kevin Horner. Thank you all for joining me today. Pleased to be joined by my friend and fellow coach, Barb Armstrong, in the chat today. Barb's going to be busy, perhaps, getting to comments and questions from all of you. Of course, happy to hear from you today. On a solo session like this, your comments and questions certainly help me out moving through the discussion topics with you all. So I'm happy to bring some of those broader macro details to the table. If you'd like to bring those in, you're welcome to do so, everyone. So please feel free to post in the chat for the duration. Remember to follow Barb and me on X, Barb Armstrong CS, Kevin Horner CS. Try to post for you there throughout the week. I've been busy this week with a bunch of charts already. Noted I was at the Nugget game last night. Nice and late tip. Always great to see a Nuggets victory, but 8 p.m. tip, very late for an early morning guy like myself. So I've got to say, I love getting to those Nugget games, but I do not love the after effects on a morning thereafter where I've got to be up and at 'em. So let's get to business, everybody. Let's jump to our disclosures, and then we'll get to the charts for all of you. Please remember that our conversation here is exclusively for your information and your education. We do not make recommendations. We do not endorse any specific approach to trading the market here. We do, however, bring technical analysis to the table as we review the broader markets. We'll look at key concepts and strategies traders might choose to employ as we review these trends of the broad market groups. We'll also move into, of course, out of indices, into sectors, industry groups, and individual stocks today as well. In fact, that's what, if you're new, that's kind of what our agenda will follow, our top-down approach. We will start with those indices. We'll move into those industry groups of note. We're absolutely going to talk about oil today. We had some difficulty there overnight as it relates to the ability to distribute oil. So we've seen a little bit of a lift in the barrels, having a little bit of weight on the broader markets. So with all of that, let's take a look at how the S&P is kicking off. And looks like a little bit of a red start. In fact, a pretty healthy red start, down nearly 1%. Everybody, we're still noting the apparent failure against the 20-day moving averages here. Notice, again, we didn't, yesterday's high didn't take us remotely close to the Tuesday high, but the Tuesday high sure points out the directional pullback we're witnessing here. We have been below the 20-day for 17 out of the last 20 sessions. So again, we can, depending on our time frame, consider the 20-day to be resistant for us, perhaps the 50-day for those of you in a little bit of a longer term window of time. Now, we, of course, have talked about the importance of the 200-day moving average. We haven't really officially tested it yet. We had that low candle on Monday, potentially in the zone, but right around 6,600, a fairly important level. Now, 400 points down from our peak, just over 7,000. It's not a huge pullback, as you all know, but it would be considered to be appropriate. We do get the standard 5% drawdown in the broader market, the S&P 500, 2 to 3 times a year. We haven't really had a whole lot of those drawdowns outside of the ugliness we got in April of last year. In fact, our last good pullback was here, where we had made our peak in October. That came around 6,900, and then we pulled back to horizontal support. That was a 5 3/4 drawdown. Now, that level is still one of merit. It wouldn't take a violation of the 200-day, as you can see, to test that horizontal ledge, which is right around 65.50 or so. So some of you traders, we always talk about the use of the moving average as support, and how when violating a trending moving average, a dynamic trend line like the 200-day moving average, we often will find support instead at a horizontal level. And you all who follow me frequently, knowing the Tuesday class I host, the building a stock portfolio, for example, when we're talking about starting new positions, we incorporate entrance near support if you were thinking about entrance near support in the instance of the S&P 500 and wanting to know whereby you might move on from the trade, one consideration that I wanted to mention here, just to follow a process that we incorporate in that stock building class, is to incorporate the average range of the instrument and put an exit strategy beneath your supporting moving average by the amount of that average true range. So if we were to apply ATR to the S&P 500, taking a look of about 91 points, so that's an average daily spread, low to high, inclusive of gap moves, then we would look at 6,600 and say maybe we put an exit strategy below it at around 6,010 or 6509 approximately, right? 6509, 6510. What would that look like? That level would be, let's go ahead. I wonder if we're really close to it, actually. I'm going to edit that. I'm actually just going to put it right here as 6510, just so we have an approximation of it. So if we were wondering about a violation of the S&P 500 200-day moving average by an amount of the average true range, look at where that lines up. It actually captures that last extended low we had back in November. So this all makes sense, doesn't it? An area under which a trader might place an exit strategy, a stop order. Now, I need to remind you, as always, when we're considering stop orders, we need to know that we have the risk associated with gaps. So remember, if you're employing a stop order, there's not a guarantee of price unless you're incorporating a stop limit trade, whereby you set a trigger and a limit thereafter. Once triggered, you incorporate a limit price instead. Now, you can go either way, right? But having a plan where you would choose to move on is a good way to go about monitoring your individual positions, of course. And in the instance here, incorporating the ATR below the 200-day, the only reason I'd encourage an effort to maybe consider a level just beneath the white line would be that we want to make a lower low. We want to have a validation of a broken trend. Okay. Thank you for asking, Wild Goose. The question about the class I teach on Tuesday afternoons, it's called Building a Stock Portfolio. Give you just a quick look. We've been monitoring an equity portfolio, trying to build individual share positions that we can manage and maintain for as long as possible. It's a very basic class whereby we simply buy the positions in leading groups, and then we along the way, week to week, we elevate or raise our stop orders along the process to try and mitigate the risk we have on the trade and work to capture the upside we've acquired in price action. So it's certainly, it's not a class for everybody, obviously. Many of you are not necessarily exclusively equity traders, but if you're trying to understand a process to build a portfolio, learning about leadership versus lagger groups and trading with the groups that are leading rather than lagging, that might be a good class for you. Of course, if you check that out in the calendar, remember, we have the archive available. I've been hosting that class since the beginning of this year. Okay, so there's a quick look at the S&P 500, everybody. Let's go ahead and bring us to the NDX, the NASDAQ 100. You'll notice the levels that Brent and I were talking about yesterday still maintain. The most important one here, probably that 50-day moving average. If we simply changed the chart to employ only the 50, you'll notice the time frame now we've been below that 50-day, not small. So we've been in it, beneath it rather, for the entirety of February, the first 2 weeks of March. You're getting to a 6-week window, pardon me, and it's becoming a little bit uncomfortable for the trend trader. Now, that doesn't mean, of course, that we can't get back in trend, but it does mean that we need to see some action back above the 50-day at some point in the near future. The difference in the SPX versus the NDX is we've actually had some levels that have more or less tested the 200-day moving average here. Again, if you wanted to look for validation of a broken trend, you might consider the average true range of the instrument here, which would be about 415 points in the NDX below the 200-day moving average. So just to give you an idea as to what you might expect there in terms of volatility. So of course, you know, in the NASDAQ, we know the relationship of the NASDAQ, heavy invested in technology relative to the S&P. So the struggle has been pretty real here. Now, our Russell has taken it on the chin with the extensive increase to price per barrel. We'll look at the barrel price momentarily here, but you can see the Russell off 1.5%. We've got a broken uptrend, no matter how you draw it. If you're looking at it from the dynamic trend line standpoint, you've got the 20-day crossing the 50 to the downside. That's less than ideal from the trend stance. Additionally, we're now beneath the 50-day moving average for solid 6 sessions. So we are definitely into that window where we're finding investors and traders a little bit less comfortable here. Now we have held our most recent horizontal support that could become coincident with the rising 200-day, which might actually strengthen that ledge of potential support right in the neighborhood of 2460 here. But what we're looking for is to get that 200-day moving average into that horizontal support, which will give us the confluence of potential support there. And so that could be quite helpful for the Russell. But it's obviously been a pretty healthy unwind here. If I drew the line to the low we just made this week, you're looking at a pullback of about 10% in the small caps. We bounced a little here, but this is not a wonderful development for the small cap positions. As you can see, we'd obviously like to see the risk factors changing a little bit here to help out the group. So let's look at, we'll make our way over to the semiconductors, pulling back aggressively at 1.7%. We've got a pretty decent risk off maneuver here this morning. Semis pulled back after rallying. Now, the interesting thing about the rally is the spot to which we stopped. Let me lift this line here. And I just want to remind you all that we have to look at some of this price action and take some of the constants of technical analysis away. And one of those constants that I'll bring to your attention here is going to be these tails right here, back-to-back tails, where we were up nicely in the mornings and did not maintain an effort to be above the 50-day moving average. Once, twice here, we were right back beneath it. Once, twice here, right back beneath it. Clearly, we do not have the makeup of a market that wants to maintain that 50-day. And today, of course, we're right back beneath it. So today's action for many traders is going to suggest a greater likelihood of moving back to horizontal support than of breaking through to the upside here at the moment. So semis are breathing a little. The bounce we got, which was an excellent candle, albeit on Monday, a beautiful bull engulfing candle, just didn't get the follow through that we needed from a validation standpoint, right? We got the follow through in the open. We gapped up and tried to fill that with a beautiful green candle on the close, and yet it didn't maintain. We had negativity in the afternoon, a bad tweet that led to selling, and then yesterday tried something similar. Note, we did not get above the high from Tuesday on Wednesday. So if we were taking just a short-term view, we had plenty of reason to believe that this was a rejection and a potential for a follow-through move today, a follow-through being an open below the low of the high day, this being the high day in the move. And today we opened below that low. So that's the inverse equivalent of the hold move, of course. So even though we've had a little bounce, by virtue of the move we've made today, opening below the low of our high day and that quick 2-day snapback, may tell us that we've got a directional move lower that's more likely than a quick reversal higher, okay? And remember, that's what we try to do with technical analysis. We try to apply probability factors rather than anything else, because We don't know what's coming. It is clearly a headline-driven market, more so than usual. And so we have to be aware of that. We have to be nimble. For a lot of us, that means that we can't take full position sizes and that we need to be a little bit more defensive, or maybe we're working with a larger balance of cash so that we can act when things change. But right now, we've got a greater risk factor than we would like to see. Now, I mentioned oil as is weighing on things, and that's probably got a big key here today as to why we're seeing the opening weakness. So we had futures off a little bit when we kicked off this morning, but mainly because oil is rallying aggressively. So this morning we had oil at 91 a barrel. Here we're over 94, almost 95 and a half. More disruption concerns. Late Wednesday, we had Energy Secretary Chris Wright suggesting that the U.S. is going to release an extra 172 million barrels of oil from the Strategic Petroleum Reserve. That'll still take, however, 4+ months to deliver. So you're looking at 120 days. Now that comes after the IEA reported a release of 400 million barrels of oil from their strategic reserves. But we also had 3 foreign ships that were struck in the Persian Gulf on an overnight basis. Attacks intensify on vessels that are sailing through the Strait of Hormuz. Obviously, this level of aggression is going to continue to put strain on the price per barrel. The level we probably need to keep a close eye on is that $100 magic zone. Over 100, that's a clear level, very round figure, obviously. But the strain we're seeing today largely tied to oil and the inflationary discussion there, and it's hitting us pretty broadly, as you can see. Let's see how that VIX is acting here as well. We've had a little spike in the VIX. We're back up over 26, pushing higher over 26 and a half. The magic level, so to speak, in here has been 30. We'll keep an eye on something in that zone. 28 to 30 here is what we've been witnessing. But again, they've been short-lived, but I wouldn't necessarily expect that to continue here because, of course, the VIX is likely to stay elevated if we continue to have risk, on the risk associated with the global situation happening. So we've got some concerns, to say the least. So be on the lookout for another type of tweet, another kind of comment, something out of the administration that could jawbone the market the other direction. We'll have to see if that plays. But right now, at least, this is where our greatest amount of risk is coming from. And I'll remind you as we talk about, oil, remember futures, these are not appropriate for all of us. So just keep in mind that you need to be familiar with the risks and disclosures for futures options contracts. And you want to do that by reading the risk disclosure statement. And you do need to be previously approved, of course, in order to do that here at Schwab. So make sure you do take the appropriate steps if you're interested. Let's work our way through the sector tool here. So I'm jumping over to the Market Watch page. We're going to see what we've got. Now, no one, after just the conversation we had, we shouldn't be surprised to see energy in the lead here today. We have utilities also kind of flat to positive, but energy still cruising as our leader. Yesterday made a nice bounce, bounced off the 20-day moving average. Looks like potential continuation today. What do you think, everybody? What would you call what we've got here developing? We've obviously got a 20-day moving average offering support, but I think a lot of you would agree with me. This kind of has the visual makeup of a bull flag situation that may have just broken to the upside. So this has the look of a continuation building chart at the moment. And of course, with higher oil and widening margins likely on many of those oil companies, this is not likely to be a negative in the near term on the energy space. 27% year to date. It's been a really great start to the year for energy as a sector. We'll see if that continues, obviously, but looking at what we've had in the way of the 20-day, you've been above it basically the entirety of this year. So if nothing else, There's a clear level under which traders would get defensive in the near term. And I say defensive, all I'm saying is it just means that the trader who's been running the 20-day moving average as support, you get under the 20-day on a close, that could be the kind of weakness that a trader uses to take a little bit of short-term profit. Under the 20, more risk that we fall to the 50-day. Not everybody's going to want to stick with the position to the 50-day. Some will take some investment out, wait and see if we find the 50-day as support, re-enter shares that they may have taken off. So you've got a way that you can go about it. Obviously, the question becomes, are you planning for it? Are you seeing this in advance? Are you setting an approach consistently so that you can take advantage of the market when it does what you may expect it to do? Okay, we'll work our way on down the list here, everyone. So there's energy. Let's move into materials. Materials, day 5 beneath the 50-day moving average here. It is getting a little long in the tooth for holding the trend support. Let's see if the low we've made in here, does this coincide with anything from a Fibonacci standpoint? You'd like this to be maybe a 50% retracement level of the entire move. That could be the case, but let's find out. Let's actually put some numbers to it with the Fibonacci's there. Okay, it's actually the 38% level. That's kind of interesting. The 50% level down below you at around the 600 zone. The 38%, though, that is a legitimate Fibonacci sequence calculation, unlike the 50%. But the 50% does tend to hold water for traders nonetheless. But anytime we are evaluating pullbacks, what we're ultimately looking for is for the pullback not to exceed 61.8%. Conveniently, in this instance, even if it did come back to the 61.8% level, there's some confluence there, huh? Look at that. We've got former resistance, which could be potential support, and then you've also got the confluence of the 200-day moving average with the 61.8% retracement. So that looks kind of interesting on materials. We'll get to precious metals there momentarily for you, everybody. I agree there, Sam. Fibonacci's are useful as a method for helping us to kind of validate our zones of support. They can be really instructive, particularly when we get important candles, nice tails, for example, below a Fibonacci level, and then we move off of it. That can be instructive. So the industrials, we'll move on here. Industrials tried for the last week to hold the 50-day. We are right beneath the 50 again, though, everybody. Look at that. We were 4 days on it. Now we're below it. If nothing else, some of you traders are going to watch the low we just made there yesterday and might have an approach that says, all right, everything to this point has been fine because we've held on a close the 50-day, and it's too early in the day to call today a true day below the 50-day. It's only the first 20 minutes, but if we traded through the low we made 2 days prior, I think some traders would certainly consider this a shifting move in industrials. They might lighten up on industrial investment there. Let's look at discretionary. Discretionary had a really struggle here. I've been trying to figure this one out in the most because, again, the pattern of action doesn't really give me a good look at things, right? What we have is a short-term downtrend. Let me put this in my lines in. So you've got this gap peak. We've struggled. You've got this, basically this falling trend, and we haven't been able to really get off of it. Now, this level of horizontal support does stand out for discretionary here. This one makes a little bit of sense, right? Look at where the tails are. Twice we've come through that ledge. Intraday, 3.3, and then a week later, 3.9, and both days saw buyers stepping in, which could validate this level for short run support. Again, remember, when we violate these levels, whether it's to the downside and we need to tighten ourselves up, or maybe it's to the upside and we wish to add exposure, it's important that we go through those steps. Having a plan, know what action you're going to take. Is it merely an intraday move that could give you reason to move out of these trades, or maybe it would give you a closing basis. Maybe you're going to wait for a close to validate that. A lot of traders will wait for closing prices, but and I think these two candles that we just spoke to point out exactly why a trader would wait for a close, because intraday, yeah, this one was as low as 1773, but we finished that day at 1830. So you had a 57-point reversal intraday. That's a big move. That's a pretty significant difference. And if you found yourself selling out at the low of the day, you might be kicking yourself, particularly if this level maintains as support going forward. And of course, we don't know, but based on the fact that we've been below the 200-day now for the majority of this move, now basically back a month below the 200-day, some of you would already have lightened up a little bit based on this. So some considerations there in terms of the discretionary space. Now, staples came yesterday to a very important level, the 50-day moving average, and I thought maybe we'd see some action here holding up. And so far, while a weak open has occurred, look at what's happened. We opened weekly, and we're trying to push higher here. So I think what it speaks to is the idea that rather than trading out of your investments to cash, what we're really getting is more rotation, money invested into defensive groups, staples, energy, materials, our year-to-date leaders, etc., right? Some of the things that we would traditionally anticipate seeing anyway. Now, that said, what's nice about the movement and the willingness of traders and investors to put their money into defensive groups is that money stays in the broader market, right? That's not money that's going to cash, going to treasuries, or real safety vehicles, right? It's money that's going to defensive sectors, which tells us there's still a level of comfort with staying invested in the broader U.S. markets. And that's ultimately a win nonetheless. Okay, keeping it true, let's move on through to healthcare. May be at a horizontal level, but everybody, you can see the difference in trend here. The horizontal level of support kind of coincident with this. So we could maybe look at this level we've created just this week. Under this, we've got former resistance, and that's going to be over the course of the next coming couple of weeks, potentially lining up with the 200-day moving average there, and that comes in right around 1700 on this particular sector index. So healthcare, yeah, maybe a bounce zone, but again, the broken trend is significant here because this was working really well. Healthcare got going beautifully and ran about 25-26%. Now, to this point, our pullback hasn't been huge, only 6%, but enough to have broken the trend. We want to see a bounce from this zone here at some point in the near run. The main reason, getting to your question here, why do you say it's a win to stay in the broader market? What I mean is, it's a win that the market, that money, the institutional investment, the money that is leaving some of those lagger groups for a year-to-date basis, like our more aggressives, right? Your discretionary and tech, it's staying in the market because it's going into energy, it's going into materials, it's going to utilities, going to staples. That's the win. What we don't want to see is we have that money leaving the equity markets. The money that leaves the equity markets is going to be more difficult to make it back into the market. That's just human nature. I'm sure many of you have taken a plan at some point in time saying, I just don't like the way the market feels. And I don't mean right now. I'm just saying historically. Think back in the last however long you've been investing. Have you said to yourself, I just don't like the setup of the market right here. Therefore, I'm going to, instead of being defensive by investing in defensive spaces, I'm just going to pull that money out of the market. But more importantly, subsequent to you having done so, when did you put that money back in? Did you put that money back in at lower prices because you were so enthused to be able to buy the market up on sale? Or did you more likely put that money back into the market when prices had risen taking you to higher levels, which would give you greater confidence to enter. But again, buying at higher prices after having left the market. So the challenge there, inevitably, isn't the willingness to take your money from the market, it's your willingness to get it back into the market. The time to be a buyer, the time when that arises, right, when the opportunity comes to the table for us to really be willing to step into the market with new cash or money that we've been sitting on, that's the time we're not going to be comfortable doing it, unfortunately. That's just human nature. Now, if we can conquer that human nature, recognize it as a red flag and turn it into a green flag. Aha, my brain is working to sabotage me. I am going to be smarter than you, brain. Here, I know better. I'm going to put that money to work because we are down X percentage, or I'm at a layer that I know to be supportive. I'm not going to do all of my dollars because that would be aggressive, but I am going to piece in at these lower prices because I recognize the need to be in the market. And if I took my money out at elevated prices, then I need to be willing to step in at devalued prices. It's a very hard thing to do. So to get back to the question, why is it good to see the market the money remaining in the market? Well, it's staying in equities broadly. That's what we want to see. We don't like the idea that comfort of investors is shifting and kicking them out of their investment money, because getting it back to work is more difficult than keeping it at work. Does that make sense? I hope so. I speak to that stuff frequently because I am like all of you. Okay, I am a trader. I'm an emotional trader. I had to recognize that about myself, and that's our job individually as traders. We have to understand who we are. We have to conquer those comments in our brain that will work to keep us from being successful. Okay, so having that mentality and understanding it, and then working through it and challenging yourself is really paramount to becoming a better investor and a better trader. Doesn't mean it's easy, okay? And that's why we try to do this every time. We try to have these conversations with you all. I hope they're helpful for you. I did see a question about healthcare. Can healthcare plan to be a defensive group? Historically, yes, you can consider healthcare, but don't forget that might change on a component basis, because within healthcare, you've got your healthcare providers, right? Your bigger providers and insurers, but you've also got biotechnology, and biotech tends to be aggressive, can be a bit more volatile as well. So that's why, when you're looking within a sector, give consideration to the sub-industry groups within it as well. Financials been getting beaten up. We made a new low in financials. Now, it's clearly not a 52-week low, but it has not been a comfortable ride on financials. We're in danger of a death cross. Reminder, death cross does not mean it has to go lower. Death cross is a bit of a lagger. Always, right? You've got a 50-day potential cross to the 50 through the 200 to the downside. So we'll keep an eye on it. But this has been likely, as much as anything, probably not tied to specifically interest rates, but more specifically the credit rates, credit spreads, willingness for high yield versus standard yields. This is just not a good looking chart. We've got the clear 20-day moving average acting as resistance. For a lot of traders, everyone, it's going to be, hey, get us back above the 20-day and then we can start talking again. Right now, at least, the 20-day comes in at a pretty important level, doesn't it? I'll just duplicate my line and snap it up there right to this spot. I mean, my goodness, if we could just get back above the 20-day for any window of time, we could possibly have something working. But right now, it is pretty clear not an uptrend, but rather not just a, we're developing into more of an intermediate term downtrend here on the financial side of things. So heads up there, everybody. Let's keeping it going. Let's talk tech. Well, we still don't have anything really to talk about, do we? I mean, we just can't get this thing rolling. So we know the level under which we got to change our opinion in all likelihood. We make new lows in technology, then we've got to be a little bit concerned. Maybe we change our process a little bit, but we still have a downtrend from the peak. And I think that, for a lot of traders, it's one of those two situations. Sandwich between horizontal support, or can we get back above the 50-day moving average? Pretty basic, right? Yeah, private credit risk. Exactly, Barbara. I know that this is something that has been seen and discussed in a lot of your financial news networks. Certainly bears keeping a close eye on relative to financials. Our communications also kind of resembling that action of the NASDAQ 100. Not quite the same amount of time beneath the 50-day moving average, but getting close. You're looking at about a full month beneath the 50-day on communications, and things look different as it relates to utilities here, getting a bounce now. Or again, reminder, horizontal support possibly holding up after violating that trend line, the 20-day moving average. Is this going to get right back above the trend line here pretty quickly? Possibly. Today's candle could be instructive for you, everybody. Look where we are. Horizontal support over the last 3 weeks. And if we get this tail to close above the high we made yesterday, we could call today a potential hold move, right? Potentially. So we got to keep an eye on that for those of you watching utilities. And then lastly, real estate. Real estate broke that range. You got the breakout. We held the 20-day for about, a month or so, and then we came back. So here we are right back into the range, a very important level on the REITs here for holding up the 50-day, because we're back into the horizontal range we traded in for, what was this, basically, let's call it May, until we busted out in February. So really about 9 months sideways. Should not at all be surprised to see a breakout in the throwback, right? But now we need to see, got to get right back above that ledge at 269 on that space. Okay, my goodness, time is flying by this morning, everybody. I apologize. I hope I'm not dilly-dallying on some of these things that don't carry as much weight for you. So let's make sure that we keep ourselves moving. Let's get quickly to what I know some of you would like to see. So we're going to use those futures symbols once more. Let's look at gold here briefly. Okay, holding on to its 20-day. Kind of settled out though, everybody. The enthusiasm may have left the gold trade, it might seem. Again, we're using the future symbols. Make sure you're doing your due diligence as it relates to futures, if that's something you want to keep an eye on. But look at that RSI, just really meandering sideways, kind of hanging on to an area of support. But enthusiasm and momentum seems to have waned a little bit in this space. Let's check out silver here. All right. So something similar playing out, a little bit more volatility of late, but nonetheless, not exactly what we're looking for, from silver. But you do have a series of higher lows and lower highs. If we looked at that on the weekly, it still looks pretty choppy, doesn't it? But you might kind of, just draw lines like, let's see here. Something kind of like, if I can put the right line in there, about something kind of like that maybe, and like that maybe. So, I mean, possibly we could be looking at, the continuation of a move, but it has been very choppy to say the least here. Difficult to really validate a strategy one way or the other, because our moving averages are all through price action, and some of these levels are really difficult. I wish I could offer you more insights than that, everyone, but that pretty much, that tells us, we just chop, and that's not to say that it can't be, back on gear at some point, but right now, chop is what it looks like. Okay, let me think here. While we're also using futures, I know I saw some of you asking about Bitcoin, so we'll quickly peek in on it. Bit of a change in Bitcoin in the sense that we are holding the 20-day. So yes, are we possibly carving out a little bit of a bottom? Possibly. Could very well be underway, but it also hasn't exactly moved through anything important. It is notable that we maintained the 20-day here this week. So you've had market weakness, you've had risk off discussion, and yet the 20-day moving average has been held for about, 4, 7, 8, 9 sessions now. So we're in what appears to be an improving potential new uptrend. And I say potential because we have to basically hold that speedy 20-day moving average. And if this is, if price action moves through the white line up here, we get through 74,000, you make a new short-term high, suddenly the 50-day moving average becomes prevalent. That comes in at around 78,000 there on Bitcoin. So that bears watching as well. Now, let's peek in on some stocks that are in the news. I had a few upgrades today. One of them was Oxy in the energy space. Oxy moving to new highs today. That's a nice development for longs and bulls, as you can see, moving through prior 52-week highs and creating new 52-week highs. Been above the 20-day moving average for a while here in Oxy, everybody. Broke out here. Really got the 20-day back basically when energy did, right? Did the same thing as the energy sector did, holding the 20-day for the entirety of the year. It's had a great run. Year to date, Oxy is up 44%. Goodness gracious. So on the heels of all of that, they were upgraded at Piper Sandler to overweight, new price target at 66. They were upgraded at Wells Fargo. They were double upgraded, that is, to overweight. Previously had been at underweight, and a new target at 69. So 66, 69 respectively, neither of which are guarantees to be achieved, whether that's an analyst value or your own measured move target. Neither one a guarantee to be achieved. So there's Oxy in energy. I wanted to also highlight Dow. Dow is one of those materials companies. We had been watching this one in the class that I noted earlier for you, that Tuesday afternoon, building an equity portfolio, building a stock portfolio. You can see this is one that's changing. That down-sloping 200-day should give you plenty of reason to look at this on a longer term chart. Today, we have managed to push up to almost a new 52-week high. We're getting kind of close, but it basically broke out from this consolidation period here. Looking at it on a weekly chart, we're running to the 100-week moving average. Not uncommon for us to find that as potential resistance, and that could be just a spot for a breather there. Dow was upgraded at Citi to buy from neutral with a new target at 40, up from 28, which is a nice improvement there. And then I had a few downgrades that caught my eye because they were downgrades in stocks in staple spaces. And I wanted to just point out because, well, invariably, what I don't like about this is they're downgrading stocks that are already beaten up. So let's look at the first one, GIS, General Mills. That's a new 52-week low. They were downgraded at Wells Fargo to underweight from equal weight. They also, Wells Fargo that is, downgraded Campbell's. Also downgraded Campbell's to underweight from equal weight. And then they downgraded ConAgra, CAG. Downgraded ConAgra to underweight from equal weight as well. So you've got 3 downgrades, all on stocks in the staple space, all stocks trading at or near lows already. Tough to suggest that they don't have more downside. I mean, lower lows are not bullish. And then try to remind you, I often said higher highs or new highs are not bearish. Well, or new lows are not bullish, unfortunately. So when you're looking at these, perhaps what you're looking for is these new lows following downgrades from Wells Fargo. If the stocks were to reverse at these levels and start acting differently following a downgrade, that could be notable. One of those things we look for, right? When markets are frothy and we have upgrade after upgrade and the stocks start to pull back following upgrades, we make note of that. When markets are ugly and struggling and you have stocks that are rallying following downgrades, we make note of that as well, because that implies that the news may very well be largely out of the price action already, right? Already built into everything we've seen. So keep all of that in mind. I know that's difficult to do, but hopefully maybe that gives you a reason to keep coming back for Trader Talk, which we host for you, of course, 4 days a week, Mondays, Wednesdays, Thursdays, and the ever enjoyable Friday session where I host with our friend James Boyd and we discuss ETFs tomorrow. So remember, ETF class, that one specifically is live only. So for those of you wondering, you do have to be here live to check that one out. We will be going live tomorrow morning at market open, 9:30 a.m. Eastern. So be here for that. We'll wrap it up today on what appears to be a little bit of a rough open. We'll see if the close resembles the open or if we get more of this reversal action midday. We've been seeing early morning weakness followed by midday to afternoon rallies, and we'll see if that kind of holds. But not a great start for us this morning at this point. As always, really appreciate you joining me, though, everybody. Please make sure you're following Barb and me on X, Barb Armstrong CS, Kevin Horner CS. Hit that thumbs up button for me down below. We get this reviewed a little later. It'll make it to the archive, and then on a replay basis, that thumbs up kind of gives the YouTube algorithm a little bit of a boost for us, and that helps to keep us in that sidebar. When you're looking through all your YouTube comments or all your YouTube channels and videos, we pop up there more frequently the more thumbs up we get. So it really helps us out on the replay basis. So final note, make sure you are subscribed to the channel, and then of course keep it tuned here for the rest of your day today. More live content coming all day. So with that, I'll leave you all be on your Thursday. Have a great afternoon. I look forward to catching up with you all again real soon.